We have a coaching call with one of our Hui Deal Pipeline Club members.
Hey, what's up, Wayne?
Give people a rough overview, a little bit about yourself, how old you are, and a little bit what you do for work, or what you did for work, and then get right into it.
Okay. My name's Glenn. I'm 36 years old, and I started an e-commerce business in 2014 and built that to where I had a team pretty much running it. I think our best month was like 250K a month. So we were doing pretty good. Me and my fiance at the time decided to travel through Asia and Europe in 2017. And I got really sick, found out that I had like parasites living inside me and stuff like that. So I ended up not being able to run the business very efficiently. And so I decided to sell it. And then after that, I ended up paying off my parents' debt and we bought a farm. So I put some money down on that. And then now I have a chunk left and I'm just trying to see where I can put it so I can potentially live off of it. Yeah. So that's pretty much it.
So in your 20s, were you a CW2 worker?
It was on and off. So since I was 19, I've started businesses like brick and mortar businesses and they would fail, or I went through the last recession and I lost my business. And then I would get a W-2 job and then I would save up money and then I'd start another business and that would fail or something would happen. This is the first successful business that I was able to sell for significant sum.
So throughout that process, were you doing any investing, or were you taking that capital and just putting it into the business primarily?
Yeah, I didn't know what I was doing. I would just take that money and put it down on a building and equipment and whatever else I needed to make sales or do whatever I was doing. But the whole investing thing to me, besides stocks, is fairly new.
And I think that I've talked to a lot of folks who are more the startup types. They should probably take their money and invest it in their own business, buy some marketing, buy some equipment, hire some employees instead of really investing in real estate. We've talked this before. Real estate's kind of an end game thing. You through hard work and a little bit of luck, you've got the nice little lottery here, able to sell this first success, big success, and that's all it really takes, right?
Yeah.
So at that
I don't
time,
want to lose it.
yeah. So you basically started at nothing, and then you sold the business recently for how much?
Just a little over 1 million.
So then you were kind enough to pay off some parents' debt.
Yeah. That was around 40,000. And then there was broker fees. And then I put it down on a farm and a couple other like knickknacks. I bought a tractor.
That was the only doodad you bought.
Yeah.
Okay. For you guys who are listening on the podcast, we do these on YouTube. Also, if you want to check that out, and you can see the financial screenshots here. We put in Excel so you can follow along that way. But we've got this tab up, just overlaid how much your net worth is. So you've got about 800 to 900 of liquid, not including all the other tractor and real estate that you live in.
Exactly.
We talked about this where you are in terms of net worth. Buying single family homes just really isn't going to do it for you. And especially because I think you're holding right now in terms of business. Right? Your highest and best use is not spending your time building relationships with property managers, turnkey providers. It's probably to go to these bigger projects and spend it on your business in the future whenever you decide what you want.
Yeah. Yeah. That's the thing is I'm looking for the next thing. Right now, I'm just focusing on putting all the assets to work. So I can hopefully it can pay all my expenses and then I can focus on something else. Still want to have some liquid cash laying around. So if there is a recession, I can jump on some opportunities, which you're always going to have opportunities. I'm just sitting back and just want to put it to work. I just don't, you're the pro. And that's why I wanted to pick your brain and see what you would suggest if you were in my shoes.
Everybody's got their own personal investment philosophy and how much risk and how much reward they're looking to take. But hopefully I can ask you some questions here and we can pinpoint exactly where you are. Like I say, I do what I do. By no means is that asset allocation mix or risk reward mix what you should do. I guess first question if I get going here, this big chunk of money that you got paid out, was that in 2018, 2019? When exactly was that?
It was January 2019.
So you're going to pay taxes on that, right?
Yeah, next year.
You still have a few months here to really shelter that. I don't think we're going to be able to invest. I don't think we're going to be able to invest more than 300,000 of it because that's just investing it too quickly. Right? You can whatever you want. You can dive off a cliff if you want to, but what are your thoughts there? Investing that much money is a little bit too fast. I think it's a little hasty.
Yeah, I don't know. Like I need this sheet with kind of if I put money in real estate and I was a real estate professional, like if I put 200,000 in there and there's this other opportunity, some coal opportunity to put 100K in there. And then there's some other opportunity. And those were all had like bonus depreciation or something. I'm still learning all this stuff, but I put it in this little calculator and then it came up to where I wouldn't owe any tax. I'm not saying that's how it's going to work out. I'm thinking of, okay, if I invest money in some things like that, if I can bring down my tax bill as much as I can, that would be great.
Before we talk about investments, we'll talk about this tax implication first, because that's the elephant in the room. You can do it naturally, which is with going into deals where you get the bonus depreciation year one and offset it. But I don't think that you're going to be able to invest that much money to offset $1 million of income. So the other way of doing it is synthetically with these more exotic investments or non-investments like land conservation easements, where you put in maybe $50,000 and you get a 3-to-1 bonus. Another way, like you said, the oil and gas stuff. But I'm not a huge fan of that because I just haven't found, there's just so many shysters. I don't even want to play in the space personally. So I can't really help you out there too much. Nobody I can really vouch for. But the year is wrapping up here. If you don't
Yeah.
place the money into natural depreciation type of deals where you're getting bonus depreciation, you're going to have to take these synthetic depreciation type of vehicles.
Yeah, exactly. So I'm kind
And
of
I,
stressing out on that.
so I see a lot of times this happens with people who read the purple book, the Rich Dad Poor Dad, and they unlock their 401k and they bring it onto the battlefield and now they have to pay taxes on it, like how you are. But those guys are a little bit different because it's usually less than your amount. It's like 500,000, 600,000 as opposed to a million. But you're starting to get to the point where you're getting very familiar to you, at least the lay of the land, as opposed to just being completely clueless. So that's a good thing.
Yeah, I don't understand the fine details, but I understand the big picture and kind of what needs to happen. I just need professionals to hold my hand and say, this is, you do X, Y, and Z, we can get your tax bill down and you're going to get, and it's going to turn off some cash and blah, blah, blah. So that's where I'm at right now. I need people to hold my hand.
And something like understand what oil and gas does to your taxes. And that's something where I would be like, yeah, you could do that, but who knows if they're ever going to find oil.
Uh, and then I heard about the conservation easements. Everyone's kind of stepping away from those because I don't know, the government, the Fed has jumped on them and is hammering people. So I'm like, great. Everything's like shrinking down on what you can do.
I think maybe at the end of this session, we can come up with a asset allocation plan. I don't want to see you invest $1 million this year, but maybe if we can make a plan for a third or a half or something like that, where you know you're going to pay some taxes. I think it's a little bit too late to shelter it all, but I'd rather have you do that than go into deals and just out of haste.
As long as it's not 250K in taxes, I'm fine paying taxes, but it's just, dude, that's a lot of money.
I think you got to get a CPA involved too, where I can help you out with the high level, but when you get down to the nitty gritty, I think that's where you need to bring on that CPA, and we can connect you with somebody later, but I can help you as much as I can. You're ultimately the one who's going to make it's your decision how you want to play this. Good problem to have though. Not many people are fortunate who have made so much money
Now it
into
is a good problem, but it's, yeah.
Another idea is what a lot of people do is they'll think of opportunity zones, which is like a newer thing, which I don't really like because the reason why it's an opportunity zone is because it's in a crappy area and it's more volatile.
What I've heard is that you can't touch it for 10 years
Exactly.
unless, and I'm like, I don't want to put a whole bunch of money in something and just let it sit for 10 years just so I don't have to pay any tax on it. Like I could put it in something else that's producing income.
But maybe if you invest 300,000 of it, and maybe if you want to just put 200 in something like that, maybe that's a good mix.
Then,
Rock in a hard place now.
yeah, I'm trying. So I don't know if I told you, but I'm trying to get to maybe 7,000 a month passively, if that's even possible. As you can see, like on the page you're at right now, from my financials or all my cost of living and stuff, it's 5,700 bucks right now a month that I'm paying. It would be nice if I could at least cover that and have a little bit more.
You guys live a pretty frugal life, so it's not. I think that's a good number to have. So one thing I always do is I'll take this number right here, or this number, and then figure out. Let's just say a 10 to 12% investment is the bronze level, and there are definitely more silver and gold investments out there, but they're not as plentiful. They're not easy available or appear all the time. And any of these investments, I mean, for you, I wouldn't plunk down more than $200,000 per. That's a lot.
You can see I have 200,000 in the AHP right now.
You might, I'll say you don't want to put any more than 5 or 10% of your net worth into one thing, but for you, you might have to bend that rule a little bit, right? Because of this predicament you've got yourself into. So cost of living is fine. The problem is you don't have any income right now, right?
I have what do I have? I have $2,600 worth of income. You
20,
look at the investment plan current, and it's funds used monthly, column D, $2,600. But that's obviously just adding to my tax bill.
what are you doing for health insurance now that you're not
I don't know. I just have emergency health insurance,
like
so I just pay 200 bucks a month.
the high deductible?
And yeah, because I was paying for some gold level stuff and then I don't know, I never hit the deductible and it was too expensive. So I'm like, whatever. I go to a functional medicine doctor anyways, half the time. So it's
Don't
like,
cover that.
no, they don't cover insurance doesn't cover anything like that.
I don't know too much about this area, but some of my friends, they'll do these like religious affiliated health plans. They're like a third to half of the price. Not saying you guys are religious or anything like that, but I hear that's an option. They don't pay for things like abortions or whatnot. So I think that's how the price comes down a little bit. But there are other things on the internet like that where it's a smaller group that are options. Or you go to the Obamacare website.
They called like a broker to handle it. And I said, I just want the cheapest coverage that
Okay.
would cover me if I was in like a severe accident and it cost $500,000 or whatever. So,
Just a side note, if you got that high deductible plan, I would be maxing that HSA out every year.
what do you mean?
With those high deductible plans, you can create like a health savings account. And those are like Roth IRAs, but you never really have to pay taxes on even the loading end. You don't pay taxes on the in, you don't pay taxes on when you spend it, and it grows tax free. But the only caveat, it has to be for health and expenses.
Yeah.
But it's
Which
pretty flexible what
you
you
would
can
use
use it
that.
on. And I would argue that you're going to need that before you ever need a IRA or retirement plan. You're going to get sick and need that medical expense before that you ever use that money.
Yeah, that's
And
true.
you can only do that if you have a high deductible plan. There's some
Mm,
definition in the IRS for that, but I think you can only put in like 6,000 a person or something like that. It's not much, but over time that should grow. And then that should cover your annual max out of pocket amount.
okay.
So put that on
Cool.
that's a smaller thing that you should put on your laundry list of things to do. All right. So you've got a really unusual profile here. You don't really make any money. You're just finding out how we got to invest this thing. So this is really where it's all going to come down to for you. So you've got a few private placement syndications, mobile home park, you got an apartment fund, and you've got a blend of some private placements. Or you're thinking about going into those things, right? You haven't pulled the trigger quite
Yeah,
yet.
exactly.
Yeah. So the blue stuff is what you're thinking of going into then.
No, the blue, I have a little schematic thing down in there. It says tax benefits with ROI over 3 to 7 years. Keep in mind, I don't know what I'm doing and I just did this. So don't. And then the green was liquid with an ROI. And then the lighter green is no tax benefit. And then the other colors, tax benefit, no ROI.
So I'm gonna change this a little bit for you. So what I'm gonna look at is just the year one depreciation amount, because there'll be some trickle off depreciation years 2, 3, 4, 5, 6, and beyond. I think we're mainly looking at the biggest amount, which is in year one due to bonus depreciation. So on the real estate stuff, I'm seeing anywhere from 60 to 90% come back. So if you're investing 100 grand into a 70 to 80% loan to value deal, which is typically most syndications, you're going to see anywhere from 60 grand to $90,000 come back year one bonus depreciation for you. Of course, there's a lot of variables, right? Age of property, how conservative the cost segregation was done. That's a range. So that you should be able to get, let's just use 80%. So your formulas work here. You should be able to offset 200 with that plan of 250. Is coal considered like an oil and gas? You get the intangible drilling. Is that why you put 100%?
No, it's a guy, that's the minimum investment. He has a deal where this guy in Texas, he traded these things that they put in coal and it extracts, I don't know, the minerals out of it and other stuff. And he sells those. And it was 100% bonus depreciation the first year. Was that it? Yeah.
Cool.
So it's not drilling. It's like some weird thing. Some guy has a patent on this thing and he needs money buying these things that extract the stuff from the coal. And then they turn around and sell the coal as clean coal or something like that.
My understanding is like the tax benefits come around when you have drilling expenses. And somehow they can connect this project with the actual bigger well drilling. I don't know if that's true. Who cares? But either way, 100% should be written off, or that deduction, not written off, but you get that deduction. The conservation easement, I'd say that's, I don't know if that's 300%. Let me just test this. I'd say it's more.
I swear it was 3 times, but
I've heard it's 5 times, but let's just go with 400 for now.
my CPA won't do that. So I'd have to find another CPA. She said she
Yeah.
could do the conservation easement, and now she's, I don't want to do that. And I'm like, oh, great.
Okay. So how much money do you have to allocate? Because you already put into this. So now you're down to
530,000. I want to get the stuff in 2% savings first.
if I'm hearing you, you just want cash today. A lot of these other deals will take a little bit to start cash flowing, maybe a year.
Because I know it's a debate if there's a recession or not coming, but if there is, it would be nice to have cash on hand because there's going to be opportunities.
Yeah. I hear a lot about Warren Buffett, how their philosophy on cash reserves, which I don't know if you exactly want to follow his advice, right? We're not Warren Buffett here, but he says somewhere around 10% or something like that. So for you, maybe 100 grand, that wouldn't be a bad way of going about it, just as a placeholder for now.
Yeah.
So do I have this right? I've had these things summed up to 550. We need to put more in here as an allocation plan.
Roommate access. You're saying for what?
This is my suggestion is keep 100 grand in cash, make a plan to invest 250 in real estate, various private placements. You already got your $100,000 in the coal.
No, I was going to talk to you about it. It hasn't opened up yet.
Then I'm thinking that maybe you put 100 grand into a conservation easement or opportunity zone fund, either or.
And that'll kind of,
right? If you don't get the warm and fuzzy from your CPA, but the conservation easement, you stick it into an opportunity zone fund, or you just eat it, right? And you keep it you eat the taxes on this and you keep it in cash as the third option. And then either way, you're holding $100,000 of cash. But I'd like to see you put this in like an infinite banking portion.
Okay.
So with this $500,000 portfolio, let's just say you're making 10%, you're making what, 50 grand a year. I'm just doing this so I can make a good estimation of how much I want to see you go in for infinite banking, because this should sustain your living expenses. Right? So it should zero out then.
Yeah. 5,000.
Yeah. So I don't want to drain your $100,000 liquidity too fast, because you have no other income coming or no other new contributions to your net worth in the cash flow.
That's why I was trying to hit 7,000, and then there's obviously some left over and I can roll that around.
So that's where I come up with this. Why don't you try infinite banking at 10 to 15,000 per year? That way you usually sign up for 5 or 6 year plans. So in those 5 years, you've put $50,000 to $75,000. So even at the end of this, you'll have 25 grand still left over. The mistake would be to put in a large amount, then you just blow through your money. And then you have to depend on these investments to pan out to make your bills paid.
Yeah. You're saying try to execute that before the end of the year, right?
No, this is
250 real estate, or that's just in general.
oh yeah. So these things in green,
Okay.
these are what you need to get done this year.
Yeah, exactly.
The health savings account, this infinite banking things, those are more ancillary tasks. So let's drill down on this 450,000. I think this is a pretty good starting point. I don't know too much about that particular co-deal, but if you like it, do it. But it's not that much more tax deductions than the regular real estate stuff, right?
So I can find more real estate deals and maybe I'll do that
Yeah.
instead.
Yeah.
And it's the cold deals putting off 7%. So it's a good return. I don't know what the average real estate deal is turning.
That co-deal, like some of these deals, they only last for a certain time frame, like 7 years. After that, the asset
Yeah.
is dead. Does that kind of component to this one?
Yep. So the cold deal is 5 years and then he buys the device back for $1 after the 5 years.
Yes, I don't like those at all. The real estate ones, they cash you out, but you have equity and you go do it again. But these oil deals, like after the oil rig stops producing oil, the thing is useless, just like ATM machines. And like that's what's nice about the farms is they go off forever.
Yeah, exactly. So you're saying I'll end up getting more out of a real estate deal than something like this coal deal.
Yeah, you got to look at that's where you start to look at IRR of deals. Most times the operator syndicator will be they'll pick a time frame to give you the IRR that looks the best, whether that's 5 years or 7 years or whatever. But if the asset is dead after 7 years, you might want to compare it on a 10-year or 15-year IRR. Because the coffee farms, just to use that example, is that like it starts off at nothing for the first few years. So your 2 year or 3 year IR is like zero, but then it starts to go up exponentially. And then on your 20-year IR, it's really high. But this one, it spikes in the beginning and it is running pretty good. But then after a certain time frame, I don't know when that is, it goes kaput down to nothing. So one way
Yeah.
of thinking about this is if you're like a mathematician, the area under the curve, that's essentially that's our money. That's what we want is the cash flow and the equity buildup, which is the area under the curve. So that's the way to visualize these two when you compare the two investments. They're not similar in time lengths. I don't want to say anything about this particular deal because I don't know anything about it. But I think that's the allure of some of these investments. They'll quote, hey, you're making 25% on the first 3 years and your tax benefits is that equipment's not worth anything after 7. And it's not like they say, hey, but we paid you out a salvage value. That's what real estate is. It's on a 5 year multifamily deal. You got your cash flow through the life of it, and then they're going to exit you out. But you're essentially paid a salvage value, right? Which is what the investments sold for. So you can take that money
Yeah.
and do it again. But in some of these other deals, like a oil rig, the oil rig's not worth jack. So there's no salvage value.
Yeah.
So you got to look at the investment from a holistic perspective and kind of understand, look at it year by year, how much money you're making from that perspective, which is not very hard, but it just takes time to understand it. And if you don't understand it, I would ask the operator to explain to you, all right, in year one, this is how much I'm going to make, two, three, four, five. And then do we get a big chunk of money at the end? No.
Yeah. I think this particular deal, he's just paying you your initial investment, paying it back every quarter, every month or whatever. He's weaving it in to the payouts. So at the end, you're done.
So that I usually ask for them, like when I want to see a pro forma, I want to see a pro forma like this, like cash flow and equity. So like a multifamily deal, you might be getting like 8%, maybe 4% the first year, just because you're not starting it right away. But then it goes up to 8 and 10. And then you've got like 50% here when the asset sells, right? Or no, I would put it in this column, this row. So you can see it visually growing up over the years. And here the total after 6 is 92%.
Okay.
But let me just make another example. This is like more typical development deal where you get like nothing and then 58% get equity. It's area under the curve was 58% in 3 years. It's hard to compare the two, right? Here
Yeah.
you would divide it by six. But some other deals, like traditionally that oil investment, it usually goes for 7 to something years, where you might get a big chunk in like year one, just because there's so much tax benefits too, which really I don't think you should factor that in, although it is. And
So
maybe
I
like
shouldn't even worry about the tax aspect.
I think it's so close. And if you're only going to get 10% or 100% in year one bonus depreciation, I don't think that's much better than the real estate stuff.
Okay. Yeah, it isn't. It's a little bit better, but
Yeah. But what you have to do is see how there's cash on equity. I think you have to do this tax calculation too, but this is based on your personal tax bracket, because they're giving you deductions. They're not giving you tax credits. So you have to make it grow through which tax bracket you're in, and you have to make it on here. So like in this investment, you got $80,000 out of your 100, but that may only be at like 50% for you. So it's essentially $40,000 of actual tax savings, but that's 40%,
yeah.
right? Whereas this deal, this oil deal that we made up down here, it was 100% of 100. Let's just say it was crazy. Like it was like 150% of 100. So let's just say it's 100% of 100. So you get $150,000 and you divide that by 50%. So that's, am I doing this right? Yeah, I think I'm doing this right.
I have no idea.
So if you invested $150,000, you're getting 150,000 of tax deductions divided by two. So that's $75,000, which is 75%. See, so you see how I compared the two? You add in the tax savings to you personally, which is like a 40% bump here. This one would be a 75% first bump to you. But then here's the difference. You're taking it on the front end, but you're not getting it in on the back end.
Yeah. It's short term.
Yeah. So in this deal, in 6 years, you're adding it all up. It's like 132%. In this year, you're adding up, it's 125%. Of course, we're missing all these per year. And I don't know if these are all correct or true, but that's extras you're trying to do here. And I think this is pretty close to real life. And look how close they come. This is 125% and this is 132%, both in 6 years. So you're splitting hairs, right?
Yeah.
Understand this, but just try your best and vet the best deals you can. But you have a sort of a loose plan here, which I think you might deviate, which is fine. But overall, the goal is to invest a lot to go to lower your taxable rate as much as you can, because your butt's kind of hanging out there this year. You're going to get killed. But at the same time, you're consciously holding on to 100 grand here and possibly another 100 grand here, but you
Oh, I
mitigate.
took that on.
Well, I don't know if
Up
you'll
to
be
you.
able to invest that. Maybe I just don't have
Yeah.
faith in you. Shouldn't
I don't
force
know.
it
I
if it
mean,
doesn't happen.
I'm not going to rely on it. That's I was hoping. It looks like that I'm just going to have to start busting my butt and finding real estate deals.
Yeah, you've got a few months left. If it's between going into deals that are like, and just to get the tax savings, maybe in your situation, that might be good. But definitely look for deals, go into deals more on the conservative end, as opposed to these other deals in like hot markets where the reversion caps are the same exact caps as the entrance caps, like the ones I always talk about that'll just get
Mhm.
killed in a recession.
Yeah.
Like, I think like for you, the thought process is be aggressive going into deals, but make sure those deals are more on the conservative side. Maybe even take less reward, because we know you're going to pay a lot of taxes, but we just don't want to run away from taxes to go into stupid deals that are just going to fall apart.
Yeah. And you end up losing your money in the first place. So, that money could have gone somewhere else.
Yeah. I would rather see you go into deals for 50 grand, but I know you're a little bit pushed here because you only have a few more months to allocate the rest. But
The clock's ticking, and it's one of those things where it's okay. It's going to have to be a couple deals. I'm going to have to put whatever 100,000 or so bigger chunks of money.
yeah, so let's talk about that a little bit. I wouldn't feel stressed out if I just left 100 or so more in cash than this. But what are you doing every day, or what are you spending your energy to go find those said deals? Maybe let's kind of address that a little bit. What are some of the
Not
performance
much.
goals?
Not much. We just bought a house, so all of last month was just moving, and then I've just been busy with life. I haven't been looking at a lot of deals. I went to Belize, used to look at cacao plantation with you and coffee plantation and stuff like that. I'm probably
Yeah.
gonna fly to Scottsdale, look at another deal later this month, and then I don't know. I'm just doing that right now,
Yeah.
checking out potential deals.
As your money guy, I know you probably want to celebrate and take a break and live life. And it's a great time in life for you right now. But this year, 2019 fiscal tax year, you're going to get slaughtered if you don't do anything. Maybe could you relax come January? Just my thought,
Yeah,
just putting my
no,
thoughts in there.
no, you're right. You're 100% right.
Just, yeah, just make a conscious effort. Nothing comes to you. Sometimes it's the best deal you go into, the ones you don't. But just put a little bit of effort in. And so you're in the mastermind. I would suggest just pinging a couple people out of that group every month. And people are people, right? They're busy. Maybe one of those two won't get back to you. But out of the one, you'll get a call scheduled every month or so and see if you gel with them. I think it just
Yeah.
takes a few good relationships in that group to unlock quadruple the amount of deal flow that you're getting now.
So you're saying just do more networking and they probably have stuff they've been working with, right? I mean, when I went to Scottsdale and met you, everyone had deals going. So do more of that.
But the traveling is hard, and I'm seeing that personally too. That's what's nice about the mastermind, right? I mean, that's why it's cheaper too. I think it's pretty cost effective. But you're trying to find yourself in high target environments where there are a lot of other accredited investors to find these deals along with you. The right conferences are great. A lot of them are more educational for do-it-yourselfers or broke people. You definitely want to go in with the lens of, is this that type that Lane's talking about, and not go to those.
Yeah.
So it's tough. And we were talking about that in the mastermind last night. But yeah, use the virtual mastermind that I've got and then see how, at least use it,
Nice.
right? That's my minimum effective dose advice is like everybody should be getting on the chat, being up some in that group. They are pretty serious. If not, I don't know why they wouldn't not return somebody from in that group. Like that'd just be stupid. You pay money for this.
Yeah. Okay. So I should be looking obviously for bigger deals, right? No single family stuff, looking for apartments, complexes, and mobile home parks and kind of stuff along those lines. Because I really, to tell you the truth, I don't want to deal with any single family drama.
For you, when you get back on the horse, your time is probably better spent doing more business activities than trying to be a landlord or even a passive landlord. So I wouldn't even waste my time there if I were you. I did have a client who he was in like the same situation as you, pretty much the same numbers. He got this big tranche of money from a sale. And what they did is they panicked because they sold the business like late 2017, which is really dumb.
So they have like 3 months left to
Yeah.
put the money to work.
Yeah. Where you have 12 months here. So what they did is they created an opportunity zone fund for this gentleman, and the money went in there and it didn't acquire anything yet. But I guess that is a little advanced trick to buy you more time. Now,
But it has to go opportunity zone eventually, right?
I don't know all the rules involved, like if you have to be the operator of that fund or if you can just use that money to invest in other passive funds in opportunity zones. I don't know all the rules, but come December and you haven't allocated all this money, maybe give me a call and we'll just try and figure out how to read that.
Your 28th, I'll give you a call.
Yeah. No, you gotta give me like December 5th or something like that.
Okay.
I think what's involved in that is creating an LLC. But other than that, you've got a few more months here to go into deals. Or, hey, if you're finding stuff not working, then just go into cash, but at least consciously do it. Go down with a fight. Here, I'll
Yeah.
just pay it to the IRS now.
What about your deals? Should we talk about those or?
You guys can take a look at that stuff. Normally, I don't like to talk with like you guys about it too much because I don't want to sell my own deals. I see it as like a conflict of interest, and
Yeah.
I should be more explaining why about the deal that you should be looking for. But yeah, we've got a
But I,
couple.
I want to know your opinion. It's not like you're some random guy.
I like it. I'm gonna put my money into it, but Yeah, we can talk about that later when we get a little more details on the project. Big elephant in the room is allocating this 400 to 500,000. And then a couple of the smaller tasks is just start playing around with a very small infinite banking at 10 grand a year or so. And then start that HSA. And
Now, what's the benefit of the infinite banking? I know a little bit about it, where you basically you can take a loan out.
making a little bit of return, right? Like 4%, but it's tax free. And that's the sort of the little loophole of this. What kind of backs this thing is it's life insurance, but we're just calling it that so that we don't have to pay taxes on it. And there's a certain limit where you can get away with this. So that grows tax free. And then, like you said, you can take a loan from it, which it's usually about 4% too, but you can use it as a business expense. So it's usually like 3% lack of taxes. So there's a little bit of a delta in there. If you're making 6% after taxes and you're paying out 4% in loans, which is nothing to hail to the gods that this is the answer to everything, but it helps out a little bit. And it's just a place to store liquidity. Look at you right now. You've got like all this money in the bank, and yeah, we'll invest it in the next coming years, but you're always going to have a bunch of cash in there.
Yeah.
And this way, when you have cash in there, it'll be making 4% tax free, which is six. And you can get at the money
And
pretty
then
quickly.
the fees are loaded up front.
And the fees are pretty heavy, don't get me wrong, but the benefit is in 5 years, you'll have a $50 or $60,000 slush fund to be able to use that whenever. And it'll be a place where maybe you might want to run your checking account through. That's what some people do, pay bills out of it. Another big thing is that it's off the table to litigators. So it gives you a little bit peace of mind with this chunk of cash.
So what would you do? Would you put a big chunk in the beginning and then pay money from whatever some of these investments and then pay into that month? Because that's how it works. You have to pay into it monthly. And then I don't know if you have to put a big chunk in the beginning or not, but
Yeah, you can do it yearly. You just have to make a contribution per year. But you have to sign up for a 5 or 6 year plan typically. So that's why I said, well, try to do a 10 grand or 15 grand the first year because you got to sign up to keep putting 10 or 15 grand every single year for the next 5 or 6. And that's where I got the 50, $60,000 amount. But in the beginning, it sucks because that if you put in $10,000, like a few grand will go to fees. And this is where this makes no sense for guys net worth 500,000 or less because they need every single penny, in this case, the $3,000 to go into their next single family home. You're in a different situation, right? You don't need to be as much efficient.
yeah.
Those guys are dab all the time, but you're just coming out with haymakers once in a while in these $50,000 investments here and there. I wouldn't do a huge amount. I hear people doing like 200,000, $500,000 policies, but I think those guys are in different stages of their life. They're more into the capital preservation mode, and that stuff is easy transferred to heirs. I know you and I aren't thinking like that yet, but I think that's the progression when your net worth becomes $5 million and over, and you're just like, I don't even know where need to put all this money.
Right now, it's just cover the bills, get all that handled. Money's working for me. It's doing its thing. And then I can step back and look at other things that potentially make me some more money, something I want to get into that I would enjoy.
Nothing is guaranteed, but if you invest this $500,000 and you're getting like 8% cash flow paid quarterly, that should pretty much cancel out your living expenses, right? So you're not going into debt, nor are you really contributing to your net worth. But as these deals start to mature, I think that's where you're going to start to build your long-term equity and when they start to come back. But that'll take a while. I think once you start to invest this and get that sustaining life coming, then you'll have the peace of mind to go back to the wheel and create that next business. But create it with that more of that abundance mindset where you're not having to worry about money, right? Because you created yourself an annuity here that I would call it a pretty conservative investment portfolio of real assets that in a recession, maybe the cash flow goes from like 8, 10% down to 5 or 7%. So now what that means is you guys might have to tighten the belt up and instead of having a monthly budget of 6,000 a month, now it's 5,000. And in the meantime, those assets are hopefully still performing and they just go slower. The payouts at the end where the value add gets implemented, it just takes longer. But in the meantime, you're still churning and you're still sustaining life with the cash flow, which is oxygen in a way. And you can focus on what you want to do because, then you can really go after it.
because there's no, like, I have a giant safety net below me. So I have to be, I'm stressed out right now. I shouldn't be stressed, but I'm stressed out because of taxes and because I'm spending more than I'm making. It's like the biggest no you can do.
Thanks for doing this. If anybody else is still listening now, if you guys like these, please share it with your friends and you might be a good candidate for one of these things. All right. Talk to you later, Glenn. Bye.
Yeah.